Hello traders, welcome back to the Forex Gig where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the high-low bands, a powerful yet often overlooked indicator that can help you identify market trends, spot breakout opportunities, and improve your entries and exit points. So stick around until the end of this video because I will be breaking down the exact step to use the high-low bands effectively, sharing key mistakes to avoid so that you can optimize trading. So let's get started. So what are these high-low bands? The high-low bands are technical analysis tools designed to help traders visualize market trends, volatility, and potential turning points. This indicator consists of three key components, which is the first is the upper band, the second is the lower band, and the third is the middle band. The upper and lower band are calculated by adding and subtracting fixed percentage, commonly 5%, from a triangular moving average, that's the TMA, which forms the middle band. Now the TMA is particularly effective because it smoothens price data twice, reducing noise and improving a clearer picture of price movement. So the primary purpose of the high-low band is to encapsulate price action within a defined range. When price approaches the upper band, it often signals overbought condition, and when it nears the lower band, it often signifies oversold condition. This makes the band more useful for identifying potential reversal points or breakout opportunity. So when price gets close to the lower band, we expect a reversal because it signifies an oversold condition, while when it gets to the upper band, it signifies an overbought condition. So let's see how we can trade with the high-low bands. We're going to look at a step-by-step way how we can tailor this strategy into different market conditions. The first way is to apply during our breakout trading strategy. This strategy focuses on capturing strong price movement when the market breaks out in a consolidation phase. When the market breaks out in a consolidation phase, step to apply. First of all, identify the consolidation phase. Now, judging from our consolidation phase, let's look for a consolidation phase. As we can see from this area, we can identify that the market is in a consolidation phase here, moving sideways in this area. So you have to identify your consolidation phase when price moves in a narrow range between the bands. You enter a long position when price breaks above the upper band, and you enter a short position when price breaks below the lower band. And as we can see in this area, price broke below the lower band, and this confirms a bearish momentum. We can also combine this our indicator, this our high low bands indicator, with our RSI or MACD indicator for additional confirmation. So when price broke out from this side, we can see it appears to be trending to the downside. This is how we can combine this with our other indicators. Now the second step is the reversal trading strategy, and this approach is ideal for identifying overbought and oversold condition. You have to first wait for price to touch or exceed the upper band for an overbought condition. Then when it touches the lower band, it also signifies an oversold condition. Remember, this reversal trading strategy is to look for reversal signals. So when it touches each of either of the upper side of the band or the lower side of the band, you would have to look out for reversal signals using candlestick pattern such as a pin bar or bullish engulfing, and so on and so forth. You can also look at indicators such as your RSI or your MACD to confirm other reversal patterns, like when price is at the lower band, if you see that it is below your 20 region in your RSI, this signifies a strong oversold position, meaning that price might reverse from the lower band to the upside. And if it's in the upper band and price is above your 80 region on your RSI, this indicates that price is in an overbought condition and we can expect a reversal to the downside because we are in an overbought condition. So we enter a short position at the upper band and we enter a long position at the lower band area. Remember to always set a stop loss order just beyond your band. So if I'm to enter a short position at the upper band, my stop loss would always be above my upper band. If I'm to enter a short position at the lower band, my stop loss must always be at below the lower band. This is basically how you set your stop loss. The next step is using the trend following strategy. This is the third step, and you leverage on the slope of the high and low band to trade in the direction of the prevailing trend. So how do we apply this? First of all, identify the slope of the band, and as you can see, it's sloping to the downside. An upward slope usually indicates an uptrend, and you would have to look for buying opportunity. When you see an upward slope, signifies an uptrend and you look for buying opportunities. But when you see a downward slope, it typically indicates a downtrend and you would have to look for selling opportunities. So you enter a long position when price bounce off the middle line during an uptrend. So when you notice the slope is to the upside, you wait for price to bounce off the middle line. When price bounce off the middle line, after you have confirmed the slope, this is when you would want to enter your trade in that direction. Then for a short trade, you would have to wait for price to bounce off the middle line or the upper band during a downtrend. So you can actually wait when price gets to the uptrend area, the upper band, and when it shows signs of coming back down, you can wait when price gets to the upper band to take your sell, or you wait for price to bounce off the middle band for a downtrend. After you have confirmed the downward slope, you can enter your sell position at this area, either the upper band area or when it bounces from the middle band area. Now the fourth step would be volatility based strategy. This strategy uses the change in bandwidth to anticipate market volatility and potential breakouts. How do we apply this? We monitor periods when band contracts. That we monitor when the band is contracting, and we can also monitor when the band is expanding. So when the band is contracting, this signals low volatility and potential breakout condition. You have to prepare to trade in the direction of the breakout once price moves outside either part of the band. So when you see a band that is being contracted, it means that we are expecting a breakout in either of the direction. We can also use a volume indicator or a momentum oscillator for confirmation. Now the fifth step is a high-low band using moving average crossover. You can actually apply your simple moving average to this strategy. You set your moving average, you use your 10 simple moving average and your 50 moving average. So you basically set your moving average, you use a 50 period length, and you can set this to an EMA of 10 to smoothen out price. So combining with your moving average, you would have to confirm and overlay a secondary moving average, that's using the 50 period moving average. Let me change the color to give us a different style. So I'll use blue for this. No, we'll use black. Use black for the we use black for our MA, our 50 period MA, and we'll use yellow for our 10 period EMA. So you would enter a long position. When you enter a long position is when you see a price crossover, when you can spot a crossover between the fast moving average crosses the slow moving average, meaning when you notice your yellow line crosses above your black line, this is when you would want to enter a long position. So the moment you notice a crossover between your yellow line, when your yellow line ideally crosses above your when your yellow line crosses above your black line, this signifies an opportunity for you to enter a long position. Sorry, I mean when your black line, remember we used a black line to signify our slow moving average, and we used a yellow line to signify our fast moving average. So the moment we spot our black line crossing above our yellow line, this signifies an opportunity for us to buy this trade. So the moment the black line crosses above the yellow line is your signal to enter a long position in that area. Then you can enter a short position when price drops, first of all, below the lower band. When price drops below the lower band, you can enter a short position when you see a crossover between the black line and the yellow line. When you notice your black line crosses below the yellow line, this will be a perfect opportunity to enter a short position when price has crossed below the lower band area, the lower half band area. This is where you'll be looking to enter a short position. An up position when price is leaving the upper band area. When price is leaving to the upper band area, maybe it's retested the lower band and is leaving to the upper band, this is where you would want to enter a long position. After you've seen your crossover, when you have noticed the black line crosses above the yellow line, that's when your fast moving average crosses above the slow moving average. This is typically when you would be wanting to enter your trade for a long or a short position. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe, and turn on the notification bell so that you will never miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.